The bank participation report came out last Tuesday, if you don't know what that is. And frankly, most people don't because it's buried in the CFTC website under reports that sound incredibly boring. It's a monthly publication showing the positions held by U.S. banks and non-U.S. banks in commodity futures markets, completely public, totally transparent, freely downloadable, and almost universally ignored by retail investors who would rather watch Jim Cramer yell about stocks. I read it every month because unlike entertainment television, this report actually tells you what the big players are doing with their money, not what they're saying with their mouths. And what I saw in the December 2025 report made me go back through historical data, cross-reference it with physical delivery statistics, compare it to vault inventory changes, and what emerged is a pattern so obvious that you'd think it was designed by someone who wanted to get caught, but they didn't want to get caught. They just assumed nobody was paying attention. Let me show you exactly what's happening using only publicly available data that anyone with an internet connection can verify in about 15 minutes. According to the bank participation report dated December 3rd, 2025, which you can download right now from the CFTC website if you don't believe me, U.S. banks held a net short position in Comex silver futures of 31,862 contracts. Each contract represents 5,000 ounces of silver. Do the math. That's 159.3 million ounces of synthetic short exposure held by U.S. banks. Net short means these banks have sold more futures contracts than they've bought. They're positioned for lower prices, or they're hedging long positions elsewhere, or they're making markets, or they're doing something clever that retail investors aren't sophisticated enough to understand. That's the charitable interpretation. Now let me show you why that interpretation doesn't hold up when you look at the pattern over time. In June 2025, according to the June Bank Participation Report, U.S. banks held 18,420 contracts net short. In September 2025, 23,650 contracts net short. In December 2025, 31,162 contracts net short. The short position grew by 72.9% in 6 months. During the same 6-month period, silver prices rose from approximately $68 per ounce in June to $75 per ounce by December. Let me repeat that because it's important. Banks increased their short positions by 73%, while prices were rising 10%. Now, I'm not a sophisticated Wall Street trader. I don't have an MBA from Wharton. But even with my limited understanding of markets, I'm pretty sure that when you're short something, and the price is going up, you're losing money. And the normal human response to losing money is to stop doing the thing that's making you lose money, unless, and here's where it gets interesting, you're not actually losing money because you're doing something else simultaneously that more than offsets your paper losses. So I started looking at what else was happening in the silver market during this period. The World Gold Council, which despite its name also tracks silver through their precious metals research division, publishes quarterly reports on global gold and silver demand. According to their Q3 2025 report, which is publicly available on their website, institutional investment in physical silver through allocated storage programs and private vaults increased by 43% year over year. Let me translate that from financial jargon into English. Institutional investment means large players with serious money. Pension funds, hedge funds, family offices, sovereign wealth funds, not retail investors buying coins from their local dealer. Allocated storage means they're taking physical delivery and storing it in vaults where it's specifically allocated to them, not commingled, not part of some fractional reserve scheme, actual bars with serial numbers registered to specific owners. And this activity increased 43% year over year, meaning there was a huge surge in institutions taking delivery of physical silver and locking it away in private vaults. So during the exact same period when U.S. banks were increasing their paper short positions by 73%, institutional physical accumulation was increasing 43%. Now maybe that's just coincidence. Maybe these are completely unrelated trends happening simultaneously in the same market with no connection whatsoever. Maybe I'm just seeing patterns where none exist because I'm predisposed to thinking big banks do sneaky things, or maybe, just maybe, some of those banks increasing their paper shorts are the same entities or affiliated entities accumulating physical metal through different arms of their operations. Let me show you how this works mechanically, because it's actually not that complicated once you understand the structure. If you're a large financial institution with both a commodity trading desk and a wealth management division, you can do the following. Your trading desk sells silver futures contracts. This creates synthetic short exposure on paper. It adds selling pressure to the futures market. It helps keep paper prices suppressed or prevents them from rising as fast as they otherwise would simultaneously. Your wealth management division or your proprietary trading arm or your private banking unit quietly buys physical silver in the spot market or through private transactions with miners or refiners or large holders. You store that physical metal in allocated private vaults, not in Comex registered warehouses where it shows up in public inventory data that everyone watches, but in facilities like Brinks or Loomis in Switzerland or Singapore where your holdings are completely private. The net result, you're short on paper, long on physical, and as long as you can maintain the paper short without facing delivery pressure, you're accumulating physical metal at prices that your own paper selling is helping to suppress. It's actually quite brilliant if you think about it, and completely legal as far as I can tell. Morally questionable perhaps, but technically within the rules. And we can see evidence of exactly this pattern in multiple data sources if you know where to look. The CME Group publishes daily silver warehouse stocks showing metal held in Comex-approved facilities. This data goes back years. It's all publicly available. You can download spreadsheets and build your own charts if you're really bored on a Saturday night. Throughout 2025, while open interest in silver futures remained elevated above 140,000 contracts most of the year, and while bank short positions were increasing according to the bank participation reports, registered inventory at Comex was steadily declining. January 2024. Registered inventory approximately 68 million ounces. January 2025, approximately 54 million ounces. January 2026, in the low to mid 40 million ounce range. That's roughly 35% depletion over 2 years. Where did that metal go? Some went to industrial consumption, so solar panels don't make themselves. That's documented in industry fabrication reports. Some went to retail investment. Coin sales were strong throughout 2025, according to mint and dealer data, but a significant portion went into institutional allocated storage. 43% increase year over year, according to the World Gold Council, and that metal effectively disappears from public view. It's not in Comex warehouses, it's not in ETFs that publish daily holdings, it's sitting in private vaults owned by institutions who aren't selling it. So you have this beautiful setup where banks are short on paper, institutional investors are accumulating physical. Comex inventory is declining, and paper prices are remaining relatively stable because the short pressure from futures selling offsets the buying pressure from physical accumulation. The banks get to accumulate physical at suppressed prices. The institutions storing that physical are patient because they're playing a long game. And retail investors watching Comex prices on their screens have no idea that physical metal is being systematically drained from available supply and locked away in private vaults. It's like watching a magic trick where the magician shows you his empty hands while his assistant is backstage loading the truck. Now let me show you why this creates systemic risk that goes beyond just clever trading strategy. If banks are holding large paper short positions, expecting to cover them at lower prices, or through cash settlement, or by rolling contracts forward indefinitely, but physical supply is simultaneously being drained into private hands that aren't selling, you create a mismatch between paper and physical markets. The paper market operates under the assumption that contracts can be converted to physical metal at spot price whenever needed. That paper and physical are fungible, that the Comex delivery mechanism ensures equivalence. But if physical metal is increasingly unavailable because it's locked in private vaults, and if delivery demand increases because more contract holders decide they want actual metal instead of cash settlement, suddenly the banks with large short positions have a problem. They need to deliver metal they don't have. They need to source it from a physical market that's tighter than the paper market reflects. And they need to do this while not triggering a price spike that would make their short positions even more expensive to cover. We've seen this movie before in other commodity markets, and it doesn't end well for the shorts. Let me give you 3 examples from recent history that are directly applicable. March 2020. The NYMEX palladium market. Palladium futures trading normally for years, orderly market, good liquidity, no obvious problems. Then Russian supply concerns emerged due to mine closures and export logistics issues. Nothing dramatic, just a tightening at the margins. European physical buyers started paying premiums above futures prices, first 5%, then 10%, then 15%. Some large industrial consumers got nervous and started demanding physical delivery instead of rolling contracts. The shorts, who had been comfortable with their positions when everything was theoretical, suddenly needed to source actual metal. Physical palladium was available, but only at premiums to the futures price they were short at. The market went into backwardation, near-term contracts trading above longer-dated contracts, a sign of immediate physical shortage, and over the next several months, palladium prices rose from approximately $1,500 per ounce to over $3,000 as the market repriced to reflect physical scarcity. The shorts lost billions. Some were forced to settle at massive losses. The market learned that paper claims don't mean much when physical supply is genuinely tight. March 2022, the London Metal Exchange nickel market. A Chinese nickel producer Tsingshan Holdings held a massive short position on the LME. Estimates suggest around 200,000 tons of nickel shorts. Russia's invasion of Ukraine triggered supply concerns. Nickel prices started rising. The short position started losing money. Tsingshan needed to cover shorts by delivering physical nickel, but they didn't have it readily available and couldn't source it quickly enough. Nickel prices went parabolic, from $20,000 per ton to $100,000 per ton in 48 hours. The largest short squeeze in modern commodity market history. The LME suspended trading, canceled trades, restructured contracts. It was a complete market breakdown. Tsingshan survived only through an emergency bailout and restructuring. The shorts lost tens of billions of dollars. The LME's credibility was permanently damaged. The lesson: large short positions in tight physical markets create existential risk when delivery pressure emerges. And here's a bonus example because it involves silver specifically. January-April 2011, the Comex silver market. Silver trading around $30 per ounce at the start of the year. Healthy market, good liquidity, commercial shorts comfortable with positions. Then retail investment demand surged, partly driven by concerns about monetary policy, partly driven by industrial demand from solar panels, partly driven by speculation. Physical premiums started rising, first in Asia, then globally. Delivery demand at Comex increased significantly. The shorts tried to suppress prices through additional selling, just added to their positions figuring retail would get tired and sell. But retail didn't sell, and industrial buyers kept buying, and delivery pressure kept building. Silver ultimately spiked from $30 to nearly $50 in just 4 months. The shorts got massacred. Some smaller traders were wiped out entirely. The pattern was identical to what we're seeing now, just on a smaller scale. Banks short on paper. Banks. Physical accumulation increasing, exchange inventory declining, delivery pressure building, shorts adding to positions thinking they could manage it until suddenly they couldn't. So when I look at the current setup, U.S. banks holding 159.3 million ounces of paper shorts, according to the December Bank Participation Report. Institutional physical accumulation up 43% year over year. Comex registered inventory down 35% over 2 years. Shanghai physical premiums at $12 over spot, and delivery demand trending higher according to CME monthly data. I see the exact same pattern that preceded every major commodity squeeze in recent history. The only question is timing. How long can this imbalance persist before it breaks? And here's where the geopolitical accelerant comes in that makes this different from previous episodes. China's export restrictions on silver, officially implemented October 15th, 2025, aren't a temporary disruption that will normalize in a few months. These are policy-level decisions by a government that has demonstrated, with rare earth elements, that they maintain strategic export controls for years to decades. China isn't banning silver exports, which would be too obvious and would trigger immediate panic. They're controlling them through licensing requirements and approved exporter lists. This allows them to maintain some export flow, keeping Western industries dependent on Chinese supply, while gradually tightening the valve to achieve strategic leverage. It's death by 1,000 cuts rather than one dramatic blow. And it's arguably more effective because it's harder to mobilize a response to gradual tightening than to an outright ban. The United States recognized this threat when the Department of the Interior added silver to the critical minerals list in November 2025. That designation officially acknowledges that silver is essential to economic and national security, but acknowledgement without action is just paperwork. You can't legislate mines into existence. You can't decree refining capacity. Infrastructure takes years to build. Meanwhile, China controls the processing capacity that the world depends on, and they've demonstrated their willingness to use that leverage for strategic purposes. So you have this perfect storm building, banks with large paper shorts, physical supply being drained into private hands, exchange inventory declining, delivery pressure increasing, and now geopolitical restrictions limiting supply from the world's largest processor. Something has to give. Either physical supply will normalize, premiums will collapse back to normal levels, delivery demand will subside, banks will be vindicated for maintaining short positions, and I'll look foolish for suggesting there was any problem, or physical supply will remain tight or get tighter, premiums will persist or widen, delivery demand will increase as more traders lose faith in paper equivalents, and banks will face a squeeze that forces covering at losses, based on the trajectory of every data point we can measure, based on historical precedent from palladium, nickel, and silver 2011, based on the fact that geopolitical supply restrictions don't resolve quickly. I'm betting on the second outcome. And apparently I'm not alone, because that 43% increase in institutional physical accumulation suggests that large sophisticated players with serious money have already made the same bet. They're not buying paper futures. They could do that with much less capital and much more leverage if they wanted pure price exposure. They're taking physical delivery and locking it in private vaults, which is what you do when you don't trust the paper market to deliver when you need it. It's what you do when you think the gap between paper and physical is going to widen, not narrow. It's what you do when you've done the same analysis I just walked through and decided the smart play is to be long physical and short nothing. Meanwhile, the banks are short 159.3 million ounces on paper according to publicly reported data. Presumably they have sophisticated risk management. Presumably they know what they're doing. Presumably they wouldn't be holding these positions if they thought they were at risk, or maybe, just maybe, they're in too deep to get out without moving the market against themselves. When you're short 160 million ounces and daily trading volume averages maybe 30, 40 million ounces, you can't cover that position quickly without spiking prices. So you're committed, you have to maintain the position and hope that delivery demand stays manageable, that physical premiums normalize, that the Comex delivery mechanism continues functioning smoothly. You have to hope that nobody notices that you're short massive quantities of paper, while physical metal is simultaneously disappearing into private vaults, and you especially have to hope that retail investors don't figure out that they can buy physical silver at paper prices that are $12 below what the physical market is actually trading at in Shanghai, because if enough people figure that out, if delivery demand spikes, if the Comex can't fulfill, the entire structure collapses and your short positions become spectacularly unprofitable very quickly. The bank participation report tells you who's positioned where. The World Gold Council tells you physical accumulation is accelerating. The CME tells you inventory is declining and delivery is increasing. Shanghai tells you physical premiums are at historic highs. China tells you exports are restricted. None of this is hidden. It's all public record. The question is whether you believe these data points are telling you something important or whether you think it's all noise that will normalize. I think it's signal, not noise. I think banks are short 160 million ounces of paper because they thought they could manage it and now they're pot committed. I think institutions are accumulating physical because they've done their homework and they know something is structurally broken in the supply-demand balance. I think the gap between paper at $72 and physical at $84 is going to widen, not narrow, because the fundamentals driving it are getting worse, not better. And I think when this breaks, and it will break because mathematical imbalances always resolve eventually, it's going to make the 2011 silver squeeze look tame by comparison. Because in 2011, the shorts were at least dealing with a functioning supply chain. Now they're dealing with geopolitical restrictions and 43% increase in institutional hoarding and declining inventories and rising delivery demand all at once. You can verify every number I've mentioned. Bank participation report on cftc.gov. World Gold Council demand data on their website. CME warehouse stocks and delivery data published daily. Shanghai Gold Exchange premiums updated in real time. It's all there. Public record, transparent, verifiable. The pattern is unmistakable once you see it. Banks short on paper, institutions long on physical, supply tightening, delivery increasing, premiums exploding. Either the banks are geniuses executing a sophisticated strategy that retail investors are too unsophisticated to understand, or they're caught in a position they can't easily exit and they're hoping nothing goes wrong. History suggests the second interpretation is more likely than the first, and the current data suggests we're going to find out which interpretation is correct sometime in the next 3 to 6 months, when delivery pressure during the major contract months tests whether the Comex can actually function with 40 million ounces of registered inventory against 150,000 contracts of open interest. The banks are betting they can manage it. The institutions taking physical delivery are betting they can't. One of these groups is going to be proven correct, and the other is going to lose enormous amounts of money. I know which side I'd rather be on, the side with actual metal, not the side with paper promises, because in the end, when delivery day comes, you can't settle a contract with good intentions and sophisticated risk management. You either have the metal or you don't. And if you don't, you're going to find out very quickly what the physical market is actually trading at. And I promise you it's not $72 per ounce. It's $84 in Shanghai right now. And by the time the shorts need to cover, it might be 95 or 110 or who knows what. The bank participation report told you they're short 160 million ounces. The physical market is telling you there's a supply shortage. The math says one of these things has to give. I'm betting the paper gives first, because paper always breaks before physical reality does.